The last 3 years, insurance has been just destroying us and rising costs.
What the insurance world has done the last 30, 40, 50 years is
when we're looking at captive insurance, how does a small business owner get to it?
take the time to understand what a captive is, because the biggest pushback I get is,
What are some of those like low-hanging fruits that we see?
What are some of the benefits that you see your customers receiving?
captives give you buying power.
Tell me about the 5-to-1 ratio.
How are they evolving to deal with the upcoming changes that we have with an aging demographic?
I think for the first time since I've been doing this, we're about to see.
Welcome to Beers with Contractors.
Contractors, listen, it's Will. Today's episode, this has been a hot button for folks I talk to all over the country. It's all about insurance. Man, we've got tons of things going up, costs across the board, property and casualty, general liability, workers' comp, and we're just trying to keep our businesses intact. So today's guest, I want you to pay attention. He is awesome. He's a very good friend of mine. Wealth of knowledge is going to change your perspective on a lot of how insurance works for home service contractors and contractors alike. So I hope you enjoyed today's episode with Rich Hess. Please go down to the show notes and look up some of his info. He is a wealth of knowledge and a great human being. So I hope you enjoy today's episode. All right, Terry, how you doing, sir?
Doing well. Will, yourself?
I'm doing great. You know, you showed up in the studio early today. I wasn't going to give you a performance evaluation today. Like, you know, we get along. Like, you're a good guy. Like, do you need that from me? Do you need a 90-day performance evaluation?
When someone is turned up to an 11, you can't go much higher than that. And that is the benefit of pissing excellence most every day.
Hold on. If somebody listening to this right now can comment where that quote comes from, which movie, whoever does it first, I will personally send you a Contractors Kick-Ass shirt. Because there's not a lot of people that would understand taking it to 11. And I may have given it away with my crappy British accent, but I tell you, I was pumped. I had an appointment that I had to reschedule, so rather than you just sitting around the studio breathing in the air that I pay to condition, we actually got to shoot the breeze and talk stuff over about your business up in Guthrie that you're rebuilding and the amount of oak that you paid for. And by the way, Terry, you got to start posting this stuff up. Terry is restoring this historical property up in Guthrie. It's an old bar. Actually, you tell the story, because the bar's downstairs and then upstairs it's got an interesting background.
Well, so the definition of interesting history, it was home to one of the oldest professions known to man or known to mankind. So had a bar downstairs and they had temporary lodging upstairs. So from everyone's history, it used to be a brothel right up until like the 1920s. So, we're trying to revive the bar downstairs and class it up and make it someplace that, maybe not you would drink at, but, people similar, just a little bit more elevated than you would drink at. I don't think we're going to try and revitalize the upstairs business. That probably is less than appropriate.
Oh, you are so PG-13. It's a brothel. There was a brothel upstairs to this place. And now it's, of course, it was shut down. So we expect it was shut down. But it's been shut down. Like, there's no access to that second level from like when. Like, and it's like, I'm picturing just a bunch of artifacts up there.
Yeah, I'm pretty sure the last people we were up there were probably up there in the early 90s, because that's when I think the access was removed, or before that. The last time I was up there as we were going through due diligence to purchase the property, there's not much up there, although there is a full cast iron soaking tub, which I'm sure if that was a brothel up there, got quite a bit of use cleaning up. So, it's going to be quite a bit of work. Yeah.
Yeah. Well, it is a cool property, and you've been sending me pictures. I want you to put some of this on the internet. It's amazing what you and Carrie have done up there. So, but anyway, let's get to today's guest. I am super pumped. This person is a very good friend of mine, and today on Beers of Contractors, we're joined with a seasoned insurance executive and connector with Plexus Group. So Plexus is the top 100 independent insurance advisory firms. And this individual in particular not only has 25 years experience, but is an amazing human being, He's helped us work through several deals in my company, but also companies I know across the country. The reason Plexus and he stand out is they've just got this tailored expertise to kind of employee benefits, but they also have access to different products out there that most of us don't even know exist. And this has been a hot button for contractors this year. Actually, the last 3 years, insurance has been just destroying us and rising costs, and we don't know what to do, and just all of that. So, our guest today, Rich, helps clients craft all sorts of insurance products. Specifically, we're going to dive into a little bit to captive insurance, which a lot of people don't know about, ranging from workers' comp, pools, to contracting teams, is self-funding and self-funded. I mean, it's cool how he can create custom plans for folks. And every time I can sit down with him, I learn something more. So today's guest, Rich Hess of Plexus Group. Rich, welcome to the podcast, sir.
Thanks, Will. Excited to be here.
Yeah, so by the way, I know that was a lengthy introduction. However, let's just dive into, like, I probably missed some pieces in there because you've been in this business a long time. But your specialty, like you have access to a lot of different things, but your specialty in particular, describe that to our 5 listeners.
So I have the luxury, I guess, benefit of having done this since about 1991. And I started out, cut my teeth, if you will, at a TPA, third-party administrator. So I learned the inner workings, if you will, of claims and claims payments and so forth. And ultimately struck out on my own, became an independent broker. And I use air quotes for broker because in my world, there's brokers and there's consultants. Many of us function as both. A broker is somebody who sells you a product and they're compensated by whatever product or company they sold you, right? A consultant works for the employer, and the employer literally pays the consultant to be on their side. So anyway, I struck out and became a broker and ultimately sold my firm to one of the national brokerage consulting firms. But really where I enjoy spending my time is in the self-funded world, partially self-funded, captives, etc., helping employers manage their funds and their plans more effectively versus just buying off the shelf insurance programs that are readily available to anyone who wants to buy them. And yet the insurance companies ultimately make all the money. So they're health insurance, right? Or insurance products, but they're not health care per se. So I enjoy spending my time looking at how we make health care better and more affordable for employers of all sizes. As you are well aware, unfortunately, many small employers are just kind of stuck with whatever's available to them. They don't get a whole lot of negotiating power. So as the rates go up, it affects their budgets, and they have to decide what to cut or get rid of if they want to continue to afford insurance. So I kind of spend most of my time in the self-funded world behind the scenes, unbundling plans, if you will. I don't know if that makes any sense, but that's kind of what I do.
So, Rich, what would be some of the signs that like a small home service company like HVAC or electrical company should look at captive insurance as an option?
Yeah, so let's talk about captives. There's lots of misconceptions out there.
Yeah, and Rich, by the way, this is why I wanted you on because, man, I didn't know what it was until I met you. And then I was like, wait, what? What is this? And it's like, this is real? Is it legal? But and you did such a good job being a consultant to me. You introduced me to an expert and you had no stake in the game.
Yeah.
And now you're facilitating these with people. So this is like, yeah, I love it. Give us a history lesson. I think it's so cool.
Yeah, well, so captives, I'm a huge fan of captives and have been for some time. And back in the day, we used to try to put together association plans. I worked with several associations over the years, putting together benefits plans for their member companies of the association, but that's for another day. So captives, ultimately, to kind of break it down, captives give you buying power. So Terry, to your question, so if I talk to a small employer, under 50 employees, under 100, whatever you want to look at, they are generally going to be what's known as fully insured. They are buying insurance off the shelf. Here's the benefits. Here's what it costs. And they don't have a whole lot of options because they have 12 employees. 27 employees, whatever it is. In a captive, we're taking multiple employers, same industry or not. They don't have to be by any means. Same geography or not. So they might be in Oklahoma. They might be in 30 states, different employers. And they are basically pooling their funds, or on our side of the house, pooling their risk by putting all those employees in a similar plan or one big bucket. So if I'm a 30 life employer, I have 30 employees, give or take, and I join a captive that has 3,000 lives already in it, well, now I have the purchasing power and or discounts of a 3,000 life group as opposed to a 30 life group. I don't know if that does that help? So captives, I think where I see the most confusion on captives is I will have employers say to me, well, I just don't know that I want to take the time to understand it. Okay, fair. I've owned a small business and I know what it's like to drink from a fire hose and try to be all things. And so, right. And Will's shaking his head because he was a part of one of those small businesses that I own. So not taking the time to understand it, I get, right? Don't agree with it because it's arguably your second largest expense is if you provide benefits as an employer, other than payroll, your second largest expense typically is benefits, right? So I feel like you should take the time, whether it's the owner, CFO, general manager, accountant, whomever it is, take the time to understand what a captive is, because the biggest pushback I get is I don't understand it, don't want to take the time to learn, or I don't want to take the risk. I'm not comfortable taking any more risk.
Yeah.
Fair, totally fair. But being that you are a small business owner, entrepreneur, et cetera, you probably are used to risk. So if you understand the risk, we can mitigate it.
Well, I was going to say, and by the way, there's certain insurance, and if you're out there listening to this, like, Rich, you saw me, like, we were in the longest time, like, well, we're not going to even explore benefits because we can't afford it, right?
Yeah.
There's some that you have to have, right? General liability, workers' comp, you kind of feel like bound at the wrists to get those.
Right.
But I was shocked to see the costs associated with it. And correct me if I'm wrong here, because you kind of have like what you described as the out of box package, like off the shelf insurance or insurance, meaning health insurance or insurance plans. And then you also help some people with some self pay plans where they can even adopt some risk, but never really exit out of that and get into captives. And then you have this full lunge into captives. Am I describing that spectrum properly?
Yeah, no, you're exactly right. So quickly, 10,000 foot level, you have fully insured or off the shelf plans. In our world, we call them BUCAs because they dominate the market.
Yeah, you
BUCA.
health people, man, you got all these acronyms.
All the acronyms, right? So I'm going to try to limit the acronyms today, but one that you'll probably hear me say is the BUCAs, and we have Blue Cross, United Healthcare, Cigna, and Aetna. Okay. So the BUCAs, well, if I'm a small employer and I want health insurance for my employees, I'm probably buying it from one of those four. And in certain states, only two of those. But when you talk about think outside the box, number of ways to do it, I can go from fully insured to I can raise my deductible, the employee's deductibles, because the more out-of-pocket cost of an employee when they have a claim, the lower the premium, right? The premiums are all relative to the benefit levels. So when I go to the doctor or pharmacy, MRIs, x-rays, et cetera, how much I pay out of pocket is really related to how much premium I'm paying. And I'm a big fan of pay as little premium as possible, right? And I'll take my chances and negotiate and pay when the time comes, as opposed to giving away the money in the form of premiums. So if I'm fully insured and I'm in a standard shelf plan, it is what it is. I have no negotiating power. They tell me how much it costs and I buy it if I can afford it.
Yeah.
But I can raise those deductibles and get my premiums down And a lot of people call it a donut hole or a bridge plan, meaning, so I take my deductible up from 1,000 to 5,000, or from 2,000 to 5,000, or maybe 7,500, et cetera. I raise the deductible, the premiums come down.
Mhm.
So that's better. But then employees might go into panic mode because they can't afford $3,000 or $4,000, right, for a service.
Mhm.
What we're going to do is we're going to self-fund the amount in between 1,000 and 5,000,
Mhm.
meaning we're not sending it to the BUCAs. We're not sending it to the insurance company. We're going to keep that savings, put it in a separate bank account. And when Rich goes and gets an MRI for $1,000, well, we pay it out of that self-funded account,
Yeah.
right? Because statistically, the insurance companies obviously make billions, right? They know what they're doing. They have actuaries, underwriters, et cetera. They know where the money's made. And they make money not just on your premium dollar. They invest it, they make it on the pharmacy, all kinds of ways the insurance company makes money.
Mhm.
But these actuaries and underwriters know where the sweet spot is. And oftentimes, if you have 1,000 lives to look at, they know that only 14% of those are going to spend more than $1,000 or $1,500 a year.
Yeah.
So in between that 1,000 or 1,500 and 5,000 or 7,000, they're making all that money, right? So what I talk to employers about is just self-fund that bridge or that gap, that donut hole, and you'll be surprised, right? I'm not. They're always pleasantly surprised. After a year, 2 years, 3 years, they have this little slush fund over here because only 2 or 3 of their employees dipped into it.
Yeah.
The rest of them didn't need it. So it's just statistics.
Yeah, and that's wild because, like you and your family, I feel like you're just bringing your entire family into the insurance world. Bryce and your son is in it
Right.
as well,
Yeah.
and it's like come to the dark side. No, it's not the dark
Yeah.
side. It's all good, but like yeah, and some of this and you've seen creative ways around this that employers, business owners have educated the employees on hey, when you have a problem, run to the emergency room, go to urgent care. And
Correct.
so what are some of those low hanging fruits that we see, like good RX, other things that is reducing that risk for the owner that may be considering some partial self pay?
Great question. I get asked all the time, what do we do about healthcare? And again, is it healthcare or health insurance? But we'll use healthcare for today's
Yeah.
conversation. It's education. What the insurance world has done the last 30, 40, 50 years is create confusion amongst consumers. So
Yes.
nobody really knows how it works.
Yeah. It's been I have no clue what's going on.
I have no idea. And so, if the doctor says I need an x-ray, I go down the hall and they do an x-ray and I have no idea how much it's going to cost. It's what the doctor suggested. And I have my insurance card.
Mm-hmm.
What we need to do is be consumers. And I've literally done this countless times. So somebody needs an x-ray. Okay, hold up. Don't walk down the hall and have it done at the hospital. We all have Google, right? And Siri and AI, Chat GPT. I will literally say x-rays near me, MRI near me. And all these little places pop up. Call them and go, need an x-ray. How much do you charge? Oh, $400. Okay. When can you get me in? Tomorrow morning. Versus the hospital who's going to do it and then bill your insurance company $1,200. And then you have to pay your deductible of 500 or 1,000 or 50, right?
Mm-hmm.
It's nonsense, but it's been created on purpose to keep people from pulling back the curtains and shopping for their health care. We shop for our hotel rooms. We shop for rental cars, vacations, restaurants, but we don't shop for our health care and ask, how much does it cost?
No. And do you find that correlates across all products, not only just healthcare, but property casualty, general liability, workers' comp? Does that correlate?
I couldn't speak for those. I would think there's very little shopping or consumerism involved in workers' comp
Mm-hmm.
because it's an employer expense. Like, it is what it is, right? in healthcare, the reason the premiums keep going up is because the consumers, the people, the employees and their spouses and kids are spending more than the premiums.
Mm-hmm. Yeah.
And since insurance companies are not benevolent, right? They're in it to make a profit. Then they raise your rates because you spent too much. Well, the way you don't spend too much is you compare and contrast. You shop around. You ask questions. So you mentioned GoodRx for pharmacy. I've had prescriptions that I showed up to fill and they said, that'll be $30. And I go, is that through my insurance or paying directly? And they say, that's through your insurance. Okay, it's $30 to go through my insurance. What if I pay you directly? They recalculate it and they say, well, if you pay me directly, it's $10. Well, then why would I use my insurance and pay more?
Yeah.
And that ends up good for everybody. It just saved me $20. And you can make that $200, $2,000, right? But if I'm saving that money and then it doesn't hit my health insurance plan and we all start doing that, then at the end of the year, the rates don't go up.
Mm-hmm.
So it's all about consumerism, right? And education. And I mean, what you said was brilliant. If an employer will simply educate employees on why they're doing what they're doing with the health insurance, then employees have an understanding of, oh, so if I don't go to the emergency room, but I use telemedicine, it costs me nothing. And it saves us $1,000 on our health plan, which means my premiums won't go up next year. If I need an MRI, X-ray, diagnostics, lab work, etc., I can call 3 places and ask them how much it costs. I'll go the one that costs the least. Not only does it save me money, it saves my employer money, and then my premiums don't go up next year. So educating right out of the chute, educating members like me, employees who are on the plan, spouses, children, etc., on becoming a consumer again, that's one way that small employers who are stuck in the fully insured model can at least keep their rates from going up, is by educating employees on how to be a consumer and keep the costs down.
Mm-hmm.
An emergency room is a great example. I have self-funded employers. So I'll have an employer that has 1,000 employees and I'll look at their claims data and I'll find an unusual number of emergency room visits at an average of $1,400 a visit. So I bring this back to the CFO or HR person and say, hey, so you had X number of people go to the emergency room and it cost you this much. We need to educate them to stop going to the emergency room.
Yeah.
Well, we can't do that. Like, what if it's an emergency? Well, is it life-threatening? Can they go to urgent care?
Yeah. Did they have a rash on their elbow?
You know what most of them are? Sinus infections.
Yeah. Well, I got to tell you, like we saw this back in the day, like when COVID was crazy, people were going to the emergency room for COVID tests when they could have gone to the CVS down the street for free.
Right.
And sorry, I'm laughing. It was just a wild time.
And like, I'm kind of a claims geek. Like I enjoy looking at all that data. Man, some of the claims during that time were absurd.
Yeah.
Because people were getting tested, going in for, fever. But well, everything was free during COVID. Like everything's free. Everything's getting provided. Well, no,
Yeah.
somebody's paying for it.
Yeah.
So 18 months later, all of our self-funded employers are getting these huge bills.
Yeah.
Anyway, we won't go there today.
Rich, one question I would have is, when we're looking at captive insurance, right?
Yeah.
It's something new.
Yeah.
It's something that not everyone's going to know about. How does a small business owner get to it?
Right.
Is there a secret handshake, a back door that they're trying to,
Yep.
because this is not something that everyone's going to know about.
That's right.
Yeah. Like is there a password?
No. So there's a QR code that you have to scan to get the right captive sent to you. So great question. And let's get back. I keep getting off and I'll go down rabbit holes all day on health insurance if you let me. But on captives, to your first question, Terry, they can research it on their own for sure. But it normally comes from someone like me, a broker or consultant, who says, hey, have you ever considered a captive? No. What is it? Ultimately, a captive, and it's a program, by the way. It's not necessarily an insurance company. It's a program that a piece of the program provides insurance.
Yeah.
Does that make sense?
Mhm.
So a captive is where 300 employers in multiple states have said, I want more control over my health insurance costs. I'm going to join these 3,000, 4,000, 5,000 lives. And so these employers band together and they learn about it from somebody like me, Terry. And then I take their data and I'll send it to 2 or 3 companies who manage captives. They provide captive coverage. And what that looks like is I'm an employer with 35 employees. I'm considering a captive. Here's my data. I send that in. The captive manager, the captive company, they will send us back a rate based on your census. So, Terry, if you have 30 employees and the average age is 23, and Will has the same number of employees and the average age is 53, his rates are going to be higher than yours, right? Because it's based on the census data. Now, so I'm going to get your rates back and I'm going to show you here's what it would cost you to be in it. And you decide yay or nay. There is what's called collateral to join the captive, and it's a percentage of your premium that goes in. And it's like a deposit. Basically, it goes into the fund, gets set aside, and you hope you never need it. It's kind of an emergency fund down the road. But once you're in the captive, you're now part of 3,000, 4,000, 5,000 lives, 300 or 400 employers, et cetera. So ultimately, your rates stabilize because the entire group gets rated once or twice a year, not just your 12 or 25 employees. The entire group gets rated. So you pay what your group should pay coming in based on your census, your client, whatever. And then once you renew with the rest of the group, it stabilizes theoretically. I mean, the captives that I work with are stable. They've been doing it for 30 years, 40 years, 50 years. And so you keep your rates from going up every year. Furthermore, you get TPA fees that are less than you could have bought on your own. You get stop loss insurance that covers catastrophic claims, right? Because if you have 20 employees and you have a catastrophic claim, you can't afford to pay it. That's why you buy health insurance. Well, in a captive, there's levels of stop loss insurance that anything over 50,000, 100,000, 500,000, whatever you decide is covered by the insurance. Anything up to that, the employer pays it out of their own claims fund. I feel like that was super confusing.
Rich, you've been doing this long enough that you have to have seen some success stories come out of individuals who are getting into captive insurance. What have those been, and what are some of the benefits that you see your customers receiving?
Tradies, running your small business can be demanding. You got suppliers you got to work with. You're managing crews. Hell, you're chasing sales. It's a lot to take in. Listen, if you want to grow your business, you got to stop working in it and you got to start working on it. So that's where my friends at Foundation Rescue Supply come in. You're not just getting foundation hair products and waterproofing products and air quality control products. With their nationwide distribution, you're getting a partner who knows how to help you scale. And that's why I use them. The Foundation Rescue Supply team has industry knowledge that'll help make your life easier. You get the tools, the trainings, the systems that you need to move the needle. You know, you want your sales team to close more leads? Done, because they have the proven process for that. You need your crews to work smarter, not harder? Done. Their installation training will get you out there and rocking and rolling in the field. With Foundation Rescue Supply, you're not just buying materials here, you're buying a better business system that they have helped create. And you sell more, you install more, and you grow your team. So the bottom line is this: you get best industry pricing, you get field productivity on track, and you get more revenue out of everybody on your team. So this is your chance to step up, scale up, and thrive. If you are ready to make that happen, head to foundationrescuesupply.com, check out their catalog, and speak to my friends, their team, how you can take beyond the products with your company with Foundation Rescue Supply.
So great question, because as you were asking it, I'm thinking, have I ever had a group get in a captive and leave? I think there might have been one employer, and it's because they had somebody who's hemophiliac. It was going to be $1 million. Like, hey, we're just going to buy a fully insured plan. basically let the insurance company buy the claim. But most of the time, an employer gets in a captive, and not only do they end up loving it because it stabilizes their rates and they get more buying power, but over time, several of the captives that I work with, whomever's in the captive, if it shows a profit, so let's say there's 10 million a year going in and only 8 million of it gets spent that year, then the members of the captive, the employers, not the individual employees, the employers, they get back a profit share annually based on how the fund did. So you can bet that whenever I deliver that message to an employer, hey, not only are your rates not going up, you're getting a check for $17,000. They love being in a captive.
Well, and that's one of the weird things that like just blew my mind when you and I went down this rabbit hole years ago, Rich. And by the way, tell me about the 5-to-1 ratio. We talked about this a little bit a few years ago. That like out of 5 years, you typically have a loss year, right? And so insurance is a mathematical equation. It is a predictive mathematical equation, right? And so, sorry, I'm kind of front loading this, but
No.
let's talk about this 5-to-1 ratio on insurance across all products.
Yeah. So in my 30 something years doing this, I've taken, I don't know how many employers from fully insured to self funded. And it would be board meeting after board meeting, committee meeting, right? Like, we can't afford to take this risk. Why are you suggesting it? The reason I'm suggesting it is if you are paying one of the BUCAs, one of the insurance companies, $1 million a year in premium, do you think they're making a profit? Of course they are, right? They have actuaries and underwriters and they know exactly. So if you take that same million and you put it in your own bank account and you have someone adjudicate the claims, a TPA, you buy stop loss insurance, sleep at night insurance. In fact, I'm going to pause there. And I know exactly what you mean, the 1 in 5 years now, because statistically, every 5 years, employers will have a bad claims year. Like, I remember some of my first ones vividly because they blamed me, right? You convinced us to go self-funded, and we had a lady who had premature triplets, and somebody else was diagnosed with cancer and had to go to MD Anderson in Houston. And
Oh,
we had a car wreck with 4 members in the same car, and we lost $100,000. This is the dumbest thing ever. You're right. You had a terrible year, and it cost you. But 4 years, you made $100,000. So you got 400,000 in the bank account. This year it cost you 100. You got 300 left. Typically, an employer will have 1 bad year out of 5. And so it's those 4 years that are good that you squirrel that money away. You keep it in the claims fund and you build up. And ultimately, my goal is always to get an employer to where they have 1 year's worth of premium in their claims fund. So theoretically, they're getting 1 free year of health insurance because they're going to continue paying into it. Obviously, they're not just going to stop paying, but they have saved up as much as it costs in a year. So it takes about 5 years for it to really level out. Now, right now, we're talking about self-funding or partially self-funded because I said I was going to pause there. Stop loss is where I think most people just don't get it. They think it's too risky to go self-funded. They think it's too risky to join a captive, when in reality, all you're doing is shifting it, because what we do is we buy stop loss insurance. So again, let's pretend that I have 50 employees and I'm paying one of the BUCAs $1 million a year, $2 million a year, whatever it is. And I say, you really need to be putting that in your own bank account and self-fund your medical or join a captive. Oh, I can't, that's too risky. Well, here's what we're going to do. We're going to buy stop loss insurance. What that means is you're going to pay a premium. It's going to be $10 a person or whatever, very affordable. And any claim over 50,000, 75, 100, whatever you can stomach, Anything over that, the insurance company is going to kick in and pay it. Anything up to that, it's just going to come out of the claims fund. Well, how are we going to get enough money in the claims fund? Well, how much are you paying Blue Cross? $75,000 a month, $50,000 a month, right? Whatever. Okay, well then let's put $50,000 a month in your claims fund. You're already spending it now. Okay, yeah. So we're going to put it in the claims fund, or we're going to put 30,000. Again, whatever you're comfortable with as an organization, and we're going to pay all those little claims, doctor's visits, MRIs, X-ray, all that little stuff comes out of there. If you have a catastrophic claim, the stop loss insurance is going to pay it. So that's how you mitigate the risk. And then ultimately, hopefully, at the end of 12 months, 15 months, 18 months, 2 years, you literally have built up a fund that would have been the profit of the insurance company you used to be paying. Does that make sense?
Yeah.
Yes, absolutely.
So back to the captive, Terry, because I kind of got down the self-funded route. In a captive, we are all buying into this pool, right? And it has stop loss insurance for any claims over, say, 25,000, 50,000, 100,000, whatever. And all the claims up until that is paid out of the fund. The beauty of a captive is, as an organization, I'm not self-funded. I'm part of a captive, and my risk is limited to the risk of the entire pool, not just my claims dollars. So if the three of us said, none of us have enough employees or money to be self-funded, it's too risky individually, but we want to put all of our employees in a pool and buy stop loss insurance, that's kind of a captive.
Now, Rich,
Yeah.
one thing, everything you've been talking about is, insurance for your employees and stuff like that, right? On my side of the equation, if I'm looking at
Right.
real estate and rental property, is there anything similar in terms of captive insurance that would be applicable to an investor, where I can get into a group of a body that's self-funding insurance on these properties?
When you say on these properties, are you talking about as the owner
Correct.
of the properties
No,
buying health insurance, or are you talking about
Insuring the
insuring the
physical
property?
property itself, not looking at the liability aspect of it, but the insuring the property? Because we've seen home construction costs just skyrocket, and insurance costs have skyrocketed right along with them.
Right.
Is there an avenue where those costs can be reduced?
I would assume so. I don't typically get involved on that
Okay.
side of the house, if you will. We have people who specialize in property, casualty, liability, umbrella coverage, and I hear them talk about it. So I have to assume that, yes, there's very similar vehicles or tools to manage those costs. I'm just not familiar with them.
Yeah, no,
Does that
because
make
every
sense?
year that we've seen, our property insurance on any of our assets has just continued to walk higher and higher and higher each year. And my expectation is you're seeing that on your side when you're insuring the employee, but physical asset, there may be an avenue to do that as well.
I know it's been a rough market. I have friends in the business, and I mean, they have told me how difficult the market has gotten. In fact, we have people in our office who all they focus on is property and casualty insurance. Sometimes I'm on those same calls, and I've heard that the market is starting to soften slightly, but I just don't know, Terry. I wish I did. I just don't know the products and services that are available for property
That's not a
insurance.
problem.
No, what's interesting though is where I thought you were headed was, well, now if I'm self-employed, don't have employees, or maybe only have a couple of employees, is there anything out there for me? And it's difficult, right? But for really small employers or self-funded individuals, I always start with, you might check into a health share. And health share is where it's sort of like a captive for individuals. If you don't want to spend $1,200 a month on major medical health insurance, there are health share organizations where it might cost you $600 a month to be in the group. And basically everybody in the pool ends up paying claims as they come up. So if I have a claim over 1,000 or 5,000, whatever my deductible is that I chose, then the health share pool would pay that claim on my behalf.
Mhm.
Which
Yeah.
again goes back to consumerism, because if I'm going to join a health share as opposed to a fully insured health insurance product, it behooves me to shop around and get my prescriptions for less using GoodRx or asking my pharmacist or even calling some of these drug rebate programs that are out there. Or if I need like I had to have Terry, I had to have an injection in my neck a couple of years ago, and my doctor recommended it. So I was trying to avoid surgery, and they sent me to a hospital here in Oklahoma City. I called the hospital and I said, "How much is it going to be?" And they said, "Well, do you have insurance?" I said, "I do, but I just want to know how much you charge." "Well, it depends on your insurance." I got to tell you, that's one of the dumbest things I've ever heard. Why would it
Mhm.
depend on my insurance? Like, how much do you charge for this service? "Well, I'm going to have someone call you back." So they called me back and they said, based on my insurance, it'd be $7,000 something dollars. I said, "Well, what if I just paid you the day of the surgery, the procedure?" She said, "Oh, self-pay?" "Yes, $1,200.
Yeah. Yep. Yep.
So I paid them $1,200, and I still have I have the email, I have the math. They did the math for me. It'll be 7,000 something dollars. It's going to be discounted because of your insurance to this much. And then your deductible and co-insurance, you'll be out of pocket $3,000. Or you can just pay us $1,200 that day and we'll call it good.
Yeah. Well, before we get any deeper, because I know there's probably a 4 out of 5 of our listeners out there. And by the way, Terry, one of our 5 listeners is in studio today. Your dad is here in studio today, sitting on the couch out there, probably listening to us ramble, watching us go back and forth to the keg. A very loyal listener. But, I think you broke me through the gap of like, well, it's too expensive. Like, but you showed me like, let's go through the numbers. So you do that for a lot of companies. So before we get into my next question, like, how do people get a hold of you? And you're very active on LinkedIn, but you are active all over the place. And you're so like helpful, Rich. Like, I don't know if I can help you or not, but let's explore it. Because our first meeting, I was not eligible for a captive, or it was not a good resource for us. And you redirected us. And like you do that for
Yeah.
everybody. So how do people get a hold of you?
So absolutely, you can message me on LinkedIn. You can get my email address and or cell phone. I've had the same cell phone for as long as I can remember. 405-823-1127. But I do mostly, I'm more of a consultative, right? And I've always taken the approach that if it's a good deal for all of us, then it'll be a long lasting marriage. I'm not interested in honeymoons. So what I love to do is just look at companies' data or sit down and ask questions. Like, I feel like a company's benefits needs to match their culture. One of the mistakes, if you will, or problems I see, companies just try to go with status quo. And so they get a quote, and here's the deductibles, and here's the co-insurance, and here's the price. Well, are you buying what your employees want? Like, what's important to them? Would they rather have 24/7 access to a direct primary care physician? Like, maybe you should just buy a direct primary care subscription on all your employees and then buy a catastrophic policy with a high deductible that doesn't cost much, because maybe your population doesn't need all those bells and whistles. So I like to visit with employers about their culture, how many employees, where are they located, why do you have benefits? And I learned this early on, Will, because I had an oil and gas company client and their rates were going up. And I didn't want to deliver the bad news, but it's my job. And so I went to them with options to keep their costs down Like, let's strip out the drug coverage and let's raise the deductible and let's do these things creatively to keep the prices down. That CEO said, absolutely not. I want the best plan money can buy and I want everything covered. Well, okay, it's going to be $1 million a year, right? He goes, no problem, set it up. Because as a small oil and gas company, he's competing with the Chesapeakes and Devons for talent, right? He had 23 employees. So he needed the same or better benefits that the big boys were providing. So I love a consultative approach, like what makes sense for you? And you might need to be fully insured. I gave the example earlier of I had a client who had a hemophiliac and it was going to be $1 million. It made sense for them to go fully insured because the insurance company was going to pay for the drugs.
All right, so hold on, Rich. You got to get your crayons out. You said this hemophiliac thing, and I feel like a complete idiot. TikTok is a crazy world of just hatred and trolls and people. So, what the hell's a hemophiliac, Rich?
Well, so it's a blood disorder, right?
Oh, okay. I could have Googled it, but for the sake of content.
And the drugs to treat it are unfortunately just off the charts expensive. Now there's programs out there, right? Available. In fact, as a matter of fact, it's a blood condition. And if I recall, it's hereditary. I mean, I'm not a physician. I just see the claims all the time. Anytime we see hemophiliac as a diagnosis, we know it's going to be an expensive claim.
Mm-hmm.
But we were talking about other ways, there's rebates.
Let's call out the maturity of Terry right now. Are you just giggling over there?
No. About
No.
what
I'm just, I'm picturing him like referring, like going over these claims, right? And he's like, oh no, it's going to be costly. Just like the things that like in his, in his industry, right? It was like a red flag just flashing that me and you would be like, what's that word? How do you pronounce it? And he understands it like that.
Yeah. Yeah. Rich, you should correlate cost association of insurance plans with owners and ADHD ratio. As we know each other, and you've seen how wild Sydney and I correlate. It's like, oh yeah, this is going to be all over the place. This is.
Well, what's funny about you saying that though is I've learned again just with age and experience. Mm-hmm. Sometimes you just have to it depends on like with your personality, right? If I say, "Hey, Will, here's what I think you should do," you're probably going to go, "Okay, great." Like you don't want to spend 30 minutes going through the detail in the weeds, right? Now Sydney might, but I've learned to just ask the right questions and based on the feedback, make recommendations and suggestions. And there's been plenty of times in my career where I've made recommendations and or suggestions, but it wasn't monetized for me.
Mm-hmm.
I feel like eventually, right, I'll get paid based on my value. And so I've had companies where I say, listen, give me all your data. I'm not going to charge you anything. I'm going to look at it. And then I'm going to come back. I'm going to do an evaluation and say, I think your plan is fantastic and I wouldn't do anything different. Or, hey, do you realize, because this is a real life situation that happened last year, if most of your employees who are going to this hospital, based on your claims data, would go across the street to the other hospital, your plan cost would go down 20%.
Yeah, that's crazy.
And they're like, what? I go, yeah. I mean, the same service, because medical providers all have codes that they use to bill the insurance companies and the TPAs. So you take all those codes and all those services that they had done, you compare prices. I mean, it became a law just a year or two ago that hospitals have to have transparency now so that you know how much they charge. Well, hospitals are not stupid. So what they've done is they're following the law, but it's almost impossible for the general consumer to know how to find those prices. Like, what do I even look for? Where do I look for
hold
it?
on.
What do I call it?
I was nodding my head before, but I did not know of this change. So
Yeah.
How does a consumer find that?
So again, being a claims geek, I'll go to a hospital and I'll poke around until I find where they've posted their pricing files. But then you got to look up what is it you're looking for? Are you looking for a broken bone? Are you looking for the price of Tylenol? Are you looking for a hospital bed overnight? Are you looking for an emergency? Like, what is it you're looking for? Because typically, if you go to the hospital, when you get the hospital bill, it's 13 pages long, right? So I'll go and I'll look up those codes. Well, guess what, Will Blake? They'll have one code. Maybe it's for stitches, right? Maybe it's for an x-ray. It'll have 17 different prices, right? Why 17 prices? Because they'll have 4 or 5 different Blue Cross plans, 4 or 5 different Aetna plans, 4 or 5 different United plans. Then you have Medicare pricing, you have Medicaid pricing, you have cash pay.
Oh,
So it'll go from $400 to $4,000 for the same service.
that's great.
Will, imagine being able to have 17 different pricing models for customers that you see for the same product.
Oh, and home service, it would be a nightmare.
That's right. Listen, consumers have to stop relying on the insurance company to negotiate the price. Consumers have to ask, how much is it? Because what we do is we just show our insurance card. We don't know what it's going to cost. We just know that our responsibility is $50. Mm-hmm. Well, they're billing the employer $4,000 for something that could have been $400. And that's another advantage, Terry, of being in a captive. Most captives have pre-negotiated pricing, either through a network or direct contracts. And some of them even have navigation services or concierge services, meaning that if I'm going to have shoulder replacement, instead of doing all the homework myself, I call the concierge and say, I need to have shoulder replacement. I live in Edmond, Oklahoma. Where should I go? They'll call around or use the computer, and they'll find the best price, dates, etc., my least out of pocket, whatever's important to me, and book the appointment for me.
So as you see insurance and specifically captive policies advancing in the future, how are they evolving to deal with the upcoming changes that we have with an aging demographic, change in either climate or liability structure and stuff like that?
Well, the good news is that's an interesting question, because I think for the first time since I've been doing this, we're about to see things change dramatically in healthcare, benefits, health insurance. Now, it can't happen overnight, but I think we're starting to see more consumerism, technology, AI. I'll give you an example on AI. Well, technology and AI. So both of my sons, they're in their 20s, and they don't have a primary care physician, which I don't love. But in this day and age, if one of them gets sick or sick enough to require a doctor, they pull out their cell phone and they go to the nearest urgent care or use telehealth. And the telehealth doctor calls in a script and they pick it up on the way home. Well, that's actually kind of a good thing, right? Instead of going to the emergency room, et cetera. Now, I'd rather them have a primary care physician, but technology is playing a huge role. And then on AI, you can have AI tell you how much your claim should cost. It's coming. There's actually companies doing it. So if I have 400 or 500 employees, I know typically we're talking about the small group, fully insured, captive size, 12 employees, 25 employees. But in the larger groups who hire a TPA and they're self-funded and they have stop-loss insurance, they will have the TPA adjudicate the claim using AI. So, those 17 different prices for one service, AI just says, well, this claim, instead of $7,000, should be $1,200. That's the cash pay price. Bam. Pay them their $1,200, out the door. Just save the employer $6,000.
That's wild.
That's what's coming up. I mean, like I follow a company on LinkedIn who's doing it and I'm intrigued. I love it. I've used it
Mhm.
because he does free demos. I've used it and it's amazing. I mean, you could have an employer who's paying, $10,000 for a handful of claims on their employees, but using AI, that 10,000 becomes 3,000
Yeah.
because it found all those codes.
Terry and I, and by the way, Terry's dad's in studio today. Before the show, we were just talking about, AI and creative ways we've been using it.
Yeah.
Every 2 weeks, I'm just blown away. And today taught me, like, oh, we should be using it for our auditing of our comp plans or our general ability or health plans. So it's creepy, but
It
it's also
is.
very, very cool.
Can't ignore it.
Now I've got to deliver this question, and I feel like this could almost be like a 2-3 part series here because, damn, Rich, we got a lot into the weeds into health, and you have so much. But I'm glad that you've shared so much knowledge, and you are just a good spirit and a good human being because
Well,
there's
I
I
appreciate it.
think you've consulted to me with 7-8 times and never was a dollar exchanged ever.
That's true. Yeah. But you know what? If
Mhm.
people reach out to me and they have questions, concerns, want me to look at their plans, eventually, right, I earn the business and keep it for a long time. So I have no issues referring people where they belong, looking at their data
Yeah.
for free, giving suggestions back, because eventually they'll hire me.
Yeah, and I will be very clear. I can attest to that. I suggested you to a company in the Midwest, and you redirected them to a
Yeah.
totally different firm. Like that was awesome. But you helped another company in Austin, Texas. You uncovered a massive waste of insurance coverage for a company in Memphis, Tennessee. Like you should have a cape, sir. However, now I'm going to humble you down a little bit. So we ask all of our guests at the end of each episode, like, people know me as a patron saint of screwing things up. If you're going to screw it up so bad that you can at least brag about it a little bit. So, Rich, what is a screw up you've had in your career that you screwed it up so bad, at least you can brag about it and help somebody out there in the world?
Wow, that's a tough one. Not because I don't have any screw ups. Which one do I pick? Right. So this would be interesting, I think. I would have to say about give or take probably 10 years ago, I decided to get out of the insurance business. I'd been doing it since I was 21, give or take. And I thought, I got a kid in college and a kid in high school. I'm going to go do something else. So I went and bought a franchise and I didn't ask for help. That was my number one screw up. I just thought, how hard could it be? It's a franchise. I'll go buy it. So I bought a franchise. It was in the graphics business, signs, branding, printing. And so I went to the corporate office for 11 days of training. And then I took over this existing franchise. Well, I had no idea what I was doing. I didn't understand cost of goods sold, knew nothing about the materials we used for making signs. I didn't even know the language, PVC and all the different vinyls. I'm like, you put different vinyls on cars than on the wall? Like what? And dimensions. I mean, just like somebody'd say, hey, I need a new sign. And I'm like, sold, I got it. They're like, well, do you need to know what size? I'm like, yeah, what size do you want? Right. So I knew none of that. And I mean, I don't know.
Maybe that's what
So,
the podcast should have been about, because that's a lot of contractors.
holy cow. I mean, like no. So I'm a sales guy and I'm out calling on companies. Well, I cold called Will. I've never told you this story. I cold called on a really well-known business person in our community. I mean, really well-known. Like they have billboards. They have multiple large businesses. Very, very successful. Great entrepreneur. And I cold call totally not expecting to get to meet him. And they say, yeah, come on back. And I just went in and said, I want your sign business because they have signs all over the place. He goes, okay, great. Let's go get in the car and I'll show you all the signs I need. And we drove around all these places, and he'd pull in, he'd stop me, go, I need one of those. I go, okay. And I'd write it down. And then we'd drive to the next one, and I'd write it down. Third or fourth stop, he goes, do you not need to measure these? I'm like, no, I got it.
Yeah, AI's got me.
I got
7
it.
years ago.
So anyway, I was terrible at the signs and graphics business. I didn't understand cost of goods sold, ordering supplies, supply chain, work order. I mean, I had never done any of that. So I would say that's probably an easy one to pick out as a screw up. But here's the moral of the story. It's one of the best things that ever happened to me and or to my oldest son. My oldest son jokes about it to this day. He says, I learned more in 1 year working at the franchise than I'd learned in 4 years in college. Because here's what I got out of it. I met some of the best people in Oklahoma. For that matter, I met some of the best people all over the country. I'm friends with a guy in South Africa who went through the franchise training the same time as me. And we message each other all the time on Facebook. One of the other ladies, she's up in Canada. So I met people all over the world. But just here locally, I have relationships today that I never would have had I not owned the franchise and just got in there and got my hands dirty.
Yeah.
I mean, I learned how to install signs. I learned how to cut signs, put vinyl on windows. I mean, I learned a lot and became great friends with some of the home builders here in the metro, a couple of the colleges. I mean, I could go on down the list without naming names, but I have really good relationships now because of that learning experience.
Yeah.
So good and bad, pros and cons.
And Terry, I will tell you this, to humble Rich just a little bit more, and I'm glad you said that, Rich. He did our very first wraps on our very first trucks when we moved here to open our company. And first off, let me just span this out a little bit. I want to first describe the human being of Rich when he was, and this is how we met through the sign company. The human being Rich, and then the business owner Rich in something that involves hard assets. So he loved us so much, he self-financed our first wraps for like 6 months. And we were like, if you're going to do it, great. Like, we love you, Rich. You're amazing. You're going to self-finance at 0% interest first wrap. Now moving forward as a business owner, it's like, I can successfully say like, Rich, you're a great guy, but that was a
bad
shitty,
move. Bad idea.
Right. I had to buy all the materials. I had to print it. I had all the labor costs, then all the installation labor costs. Yeah. And then,
but it shows because like when you're consulting with companies around the country, like that's just that there's no cost and you're just giving that information for free. It's not, you're not you're not supplying vinyl and things like that. So Rich, you are a massive friend of mine. You are a steward of the industry. I appreciate you being on here. I feel like this could be a 3-part series, I tell you, because of your knowledge. And I know somebody's going to be like, well, insurance, blah, 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 blah. But we didn't even crack the purpose into workers' comp general liability. I think we need to dive into that. But otherwise, to all of you guys out there, thank you. This has been an awesome episode. Dive in, reach out to Rich. And otherwise, Terry,
Good
cheers
to see
to
you,
you,
Will.
sir. And thanks for being on time. I was about to write you up. Just kidding. Otherwise, we'll see you guys next week on Beers with Contractors. Appreciate y'all. Peace.
thanks, guys.
And that's a wrap for today's episode of Beers with Contractors. We hope you enjoyed our chat as much as we did. Before we say our final goodbyes, a friendly reminder. Beers with Contractors encourages responsible drinking. If you choose to enjoy a beverage during our time together, please do so in moderation and only if you're of legal drinking age in your country or state. Furthermore, the advice and insights shared in this podcast are for informational purposes only. Always consult with professionals and experts in your field, and be sure to follow local laws and regulations regarding licensing and permits. We're here to help, entertain, and inspire, but your safety and compliance are important. So, as you head out into the world of construction and contracting, remember to build responsibly and make decisions that stand the test of time. Thanks for joining us today. We'll catch you on the next episode of Beers with Contractors. Until then, cheers to your success.